Good morning. This is Axel Merk, President and Chief Investment Officer of Merk Investments, with my update this Wednesday. It's Wednesday because we had a holiday on Monday, so only 2 days into the trading week. The market has taken a turn since it opened, and we were in a good risk-on mood, so to speak. Dollar was weaker, but that has changed a little bit right now. Actually, the S&P futures are flat. The Dow Jones is still up 220, I see here on my screen. But the S&P futures definitely has come down from the top, and the dollar has strengthened a tad. Weakest currency today is the Australian dollar, is now down over 1%, and the euro is still up a tad, 7 basis points. And the bonds, the 10 years up 5 ticks, the 30 years up 5 ticks as well. The 3-month T-bill is at 13 basis points, and the 3-month LIBOR at 37. The Fed funds effective rate is at 5 basis points. And then on the gold is down today again. Is down 70 basis points on the spot market at 1698. And the crude market is down 3% for West Texas, down $1.10 at 33.20 something rather, and Brent is down just under a percent at 35. I'm 31 right now. I see the Brazilian real is the strongest currency on my board for EM currencies that I monitor, and the ruble, the Russian ruble, actually the Mexican peso right now, they are trading places here down 80 basis points. So, economy is gradually opening up again. Hairdressers are opening up in California, I hear, although not in the Bay Area. So I still have to wait a little bit, I suppose. A few things happening. One of the big things out there is today, big thing, and well, let's talk about the more important things, I guess. Today, in Williams, the New York Fed president, he was just talking, had a good interview. The thing that caught my Williams is the New York Fed president, who was the San Francisco Fed president, as you may recall. He got a little overwhelmed, at least that was my way of thinking about it, when it was difficult to manage the Fed funds market, and he had to intervene in the market. Learned a lot on the job, but now he's talking about yield curve control. He was asked about it, and he didn't say the Fed is going to pursue yield curve control, but he shrugs it off as yet another tool in the toolbox of the Fed, and it depends on the economy whether they'll use it or not, and so forth. I'm not so sure whether people are fully aware what yield curve control means. Historically, the Fed is controlling the short end of the yield curve, and they have done that with repos, reverse repos, but then shifted towards interest on excess reserves. And then with forward guidance, they've tried to manage the yield curve further out. But there's a reason why it's only quote unquote guidance, because it is very difficult to keep rates in the longer end at a certain level. With forward guidance, they have done a reasonably good job, but the Japanese, for example, they try to target the 10-year rate as well. And the Japanese own the 10-year market. There's very little liquidity out there. The US is a little different. We are the reserve currency in the world, and there are benchmark rates, and there is massive amount of debt issued that is somewhat trading off those rates. And indeed, yes, many international markets also trading off that in a certain spread. And the point being is that it takes more than buying the treasuries to set the treasury rate. Obviously, you may only be able to buy those, but it is other rates that influence these as well. And it's like zipping from a straw in the ocean, trying to control the 10-year rate. That works very well when the market loves the Fed and everything is great, but let the market challenge the Fed, and things look different. There is, and as I've explained before, a chance that inflation expectations might get dislodged, and then all bets off. Then that sort of policy an extreme expensive one, and I wouldn't mind having the folks at the Fed being tad more humble when they throw out words like yield curve control, rather than talking, oh, it's just another tool. Yeah, maybe we'll use it, maybe we don't. We'll let you know about it, type of thing. And so that's rather concerning in my book, at least. Then the blogosphere is all excited and about the fact checking that Twitter has introduced, and um, at least for the presidential tweet, and so then Trump pointed out, and this was about President Trump tweeting that using mail-in ballots invites voter fraud, and then the fact checkers pointing out that that is not correct. And indeed, Twitter put a little line under the tweet saying, check the fact, or something like that. And then Trump pointed out, oh, it's CNN and the Washington Post that contradict this. Well, I'll talk about the substance of the mask in a second, but Twitter seems to be taking a slightly different approach from Facebook, and obviously I don't know much about it at this stage. Appears to be a work in progress in some ways. But whereas Facebook, when they have done their fact checking, they have these very manually procured answers as to, or links sending to specific sites. And one of the challenges with the fact-checking sites is that they have become politically biased themselves. If you read some of these fact-checking sites, then they have an agenda themselves. They're not just fact-checkers. And as Trump is pointing out, that CNN isn't exactly unbiased either these days. And so, but what Twitter seems to be doing is they are crowdsourcing the fact checks, it seems. And if that's where the emphasis is going to be, this could be a very exciting and engaging way of doing it. Obviously, then a lot of people are going to jump on that and try to become your closet fact checker. But I guess that's happening already in some ways, but it's just going to accelerate that. And so the policing is going to increase. So I kind of like that idea that you crowdsource the fact checking, and then you see different points of views as part of that and open a debate about it. Let's see. It's really a lose-lose situation for Twitter if they let things go unchecked, so to speak. They're open for criticism. If they do check them, they are certainly open for criticism as well. And so we'll see. Obviously, President Trump has already said he's going to regulate social media now, and that's itself going to be an interesting political hot potato of how that's going to evolve. Ultimately, any regulation helps the ones that are established. More on the substance side, the reason why I think that this sort of tweet is not helpful is because it's going to kill people. And the reason I say that is that in the COVID-19 era, if you're vulnerable, you probably should not be lining up at the voting booth. But maybe everything is under control by November, and so maybe it doesn't matter. But if anything, we should be encouraging people to use mail-in ballots and vote remotely. And so that's just my 2 cents on the political side of that. Then von der Leyen, the EU president, she says it's the EU moment. She proposed a 750 billion euro budget. That's a little over 800 billion US dollars. Or not budget, initiative to help in the recovery, of which 2/3 are supposed to be spending and 1/3 is going to be loans. Calling it EU moment is the right way to call it, because the EU historically doesn't issue its own debt, and so if that is the case, a precedent is being set that's going to take the EU down a path that's closer to that of the US. And so we'll see whether this crisis will get them to go down on that path. Okay, good. And so any other changes here in the markets? VIX index has shot up, all relative speaking, right? It was just before the open, it was under 26, and now it's over 28, approaching 29 on the VIX. So clearly well below the crisis levels. The yield curve is not inverted, and indeed the S&P futures are now up $6, so they are positive right now. China, almost forgot to talk about China. In Hong Kong, the elections in the fall, and the Chinese are flexing the muscles. A guest on Bloomberg Radio pointed out this morning that the special status of Hong Kong from a U.S. point of view is under could be changed. The U.S. does not treat Hong Kong like China, but treats it independently, and that's obviously, I mean, the folks who suffer most if that is going to change is the people in Hong Kong, and so this is going to be very interesting how that's going to unfold. Could mean major things for the flows of money, of business, and obviously the future of Hong Kong and the people in Hong Kong there. The Tiananmen Square anniversary, I believe, is also coming up. And so lots of tension here on many fronts, how that's going to play out on the streets in Hong Kong and in the political halls. But the thing is, if nothing were to happen, odds are that the Chinese government might get embarrassed in the fall, and so they're flexing their muscles. Let's see. It doesn't get boring, but it appears that both the Democrats and the Republicans in the U.S. would like to use China as kind of the punching bag right now, and blaming them for things that aren't right in the U.S. And so that can well lead to some not so great things. But in the meantime, of course, yep, the markets are reasonably happy. I mean, I call this risk off, but the bonds up a few ticks, but the S&P is still positive, and as I pointed out, the Dow Jones is also positive. The euro has been doing okay. It's over 110 right now. It was attributed to von der Leyen's comments. Maybe it's always difficult to attribute those sort of things to specific events happening. Alrighty, goody. I'll leave it at that for now. Have a good day, and hope you're enjoying this shortened week. Take care.